Since the Asian financial crisis in the late 1990s, Asia's high-yield debt capital markets have expanded dramatically. During the last couple of years, where we saw an expanding global economy following the global financial crisis, the market has seen record issuance volumes. During these years, there have been exciting changes in deal structures and covenant packages in Asia. In this four-part series, we will cover the core elements of high-yield debt for Asia-based issuers. We will get into the details of a couple of the most important covenants and talk about some of the trends that we're seeing. Growth companies issue high-yield bonds to finance their expansion and to diversify funding sources from traditional bank lending. Bank lending is great, and many markets around Asia have very active domestic lending markets. However, bank covenants are typically maintenance-based, where the borrower needs to maintain certain ratios at all times during the life of the loan. As many companies found out during the global financial crisis, banks can cut you off if conditions deteriorate. Sometimes, this isn't even the company's fault directly, but rather represents a temporary downturn in a particular sector, like what we saw with decreased commodities prices that hit mining and natural resources issuers a couple of years ago. High-yield debt from the international capital markets allows a company to get some longer-term debt into its capital structure and to decrease its reliance exclusively on bank debt. This is just part of a diversified and sound treasury policy. Unlike traditional bank financing, a high-yield covenant package is self-administered by the company without requiring regular inspections by a bank lender. A high-yield covenant package includes incurrence covenants, which are evaluated only when the issuer or any of its restricted subsidiaries seeks to take some action, such as incurring debt, paying a dividend, or making an investment. The package rewards positive financial performance with additional flexibility. If an issuer has poor financial results, investors are protected by a reduction in flexibility, but not necessarily a default or acceleration just because times have gotten tough. Basically, high-yield covenants are designed to do three things. First, to prevent the credit group from borrowing too much or decreasing cash-generating assets without concurrently decreasing debt. Second, they limit the credit group's ability to subordinate the bonds through structural or lien subordination. And third, they preserve the credit group's assets in case of a default. These design features ensure that productive assets, those assets that produce positive cash flow, are protected and don't deteriorate and can still be used to service the debt. So in a nutshell, high-yield bonds are great for diversifying from traditional bank financing and putting a product in place that rewards positive financial performance. And correctly structured, they can grow as the company's business expands. In the next video, we will explain the high-yield covenant package, including understanding the credit group concept and which companies in a complicated group structure form part of that group, general principles for a high-yield covenant package, and the issue of structural subordination. These are the core principles to understanding high-yield debt, and after we lay this foundation, later videos in this series will start addressing specific covenants. Thank you for watching this video. If you found it helpful, please like or share it, and don't forget to subscribe to this channel to view the next video on this topic.